First Republic Bank officially collapses and JP Morgan comes in and picks up the pieces. So in spite of what people tell you, there is a method in how banks actually fall, fail, and then get picked up, assumed, and received. Now, the FDIC, in spite of what you guys realize, is actually protecting a lot of the consumers. And here's how. With the FDIC, what ends up happening is that the FDIC goes in when there's a bank crisis, and they're auditing banks, regional and local banks, all the time. And when these audits come back subpar and they know that the bank's in financial distress, they start going in to try to regulate it to protect you, the end consumers, the depositors, the people that are actually putting money into those banks. So First Republic Bank has $102 billion in depositors' money that they're claiming is lost, in spite of the $30 million in relief funding that they had from the feds to be able to give depositors back their money. So hence, depositors are concerned about their money. Now, understand, if you have money deposited in First Republic Bank, and I'm one of them, we actually had most of our warehouses that we owned as the depositor. We were a depositor in First Republic Bank just about a year and a half ago. We since had moved to Chase Bank, not because we felt that First Republic was subpar, only because Chase gave us bandwidth to be able to do deposits and receivables nationwide. And one thing that we liked about First Republic Bank is everything was remote. We were able to go in and do things remotely all over the place, but they just didn't have the bandwidth for growth that we were experiencing. So we landed up going with Chase Bank and moving over a year and a half ago. Now, thank God for us that we had the foresight to move out prior to any of this happening. And it wasn't foresight that was created by problems. It was just foresight created by the sheer need for us to grow and expand our business nationwide. Now, what ends up happening is that the FDIC comes in, and the FDIC, their job is to protect the consumers, you guys. And so when they come in, they realize there's a problem. They halt the bank, and they come in with their accountants, their CPAs, they come in with their firm, and they take over the entire bank. So in spite of the owner, the CEOs, and everybody, they come in and push all of the administration aside, they push all the executives aside, and then they come in and they take over the entire bank. Then the bank, once they get it under control, if they're able to stabilize it, if the original owners of banks like Silicon Valley Bank or the original owners of banks like First Republic are able to go in and stabilize their assets and get things worked out really fast, they can retain it. But if there's so much financial distress that they can't hold on to it, which First Republic Bank has shown that they can't, with over $130 billion in depositors' money in distress and only $30 million to recover it, there's a massive gap of over $80 billion that hasn't been recovered yet. And so depositors calm down, relax, because the FDIC and the feds will actually cover those funds. Because what happens is once a bank in itself, any regional bank, national bank, or local bank gets taken over by the FDIC, they auction it off. So it just so happens that JP Morgan Chase is the one that picked it up. So what's going to happen is that 80% of any losses that JP Morgan experiences from any of the pre-existing debtors, people that have taken notes out, residential or commercial notes, will be covered by the FDIC and our feds. And so depositors, your funds will be okay, because a bank that's stabilized, they won't let you go in the red. They're going to make sure that you stay in the black and that you get your money back. So the goal is to have a bank like JP Morgan Chase come in and take over the assets to be able to go in and stabilize the bank. And then the feds will back and insure everything that JP Morgan holds, so that way JP Morgan doesn't bear the stress of bad debtors to the corporation, which brings JP Morgan down. They want to make sure that now the bank gets stabilized, the systems and processes that are utilizing are going to benefit the end users and the people that are getting bandwidth for loans, commercial and residential, that they have a status quo that doesn't allow them to go south like First Republic did. Now, what's stimulating all of this? Let's talk about the housing market right now. Let's talk about this interest rate hike that the feds did, because all of this is a reciprocation of everything that's going on right now in the market and even what's happening with the downfall of banks. First Republic being the second largest downfall of any bank in history right now. So as far as large banks that have went under, right now in U.S. history, First Republic is the second largest bank that's ever been taken under. What is the cause of all this? And that's what most people are asking, like, where is my money safe? Well, the good news is that things on the mortgage front seem to be more stabilized right now. And in fact, what the feds are saying, in spite of them increasing interest rates just over the last week, and in us going into a place where the interest rates are higher, the 30-year fixed mortgages are stabilizing and may even be coming down. 30 days ago, we were sitting at a 30-year fixed mortgage of 6.59%, and today they just went down to 6.48%. So an 11% decrease in mortgage rates on 30-year fixed over the last 30 days, which means home buyers, this is your time to purchase. Rates are stabilizing, mortgage rates are starting to come back down, and this may be the last federal income tax hike that, or not income tax, this may be the last federal interest rate hike that we see over the next few months. Now, not to say that interest rates aren't going to go up again before the end of the year. I truly believe that we're going to see some quarter basis point increases, probably 2 more at the very least before we get to the end of the year. And it was the Fed's ploy to be able to come in and stabilize inflation, which now inflation is slowly starting to soften. We're not seeing the robust increase in raw materials and raw goods, lumber and commodities that we were seeing just a year ago. And now that the market is starting to stabilize, unemployment is slowly starting to go up. And those were the signs that we were looking for to make sure that inflation was being stabilized, hence the Feds being able to take their foot off the pedal on increasing interest rates. With money being more expensive and the Feds pressing financial institutions has really been the biggest portion of bank failures that are happening right now. Anytime money is expensive, ladies and gentlemen, it's not just expensive for you. It's expensive for financial institutions as well, because their rate to lend has to go up. So if they've lent money at a lower rate and they don't have the bandwidth to recuperate that money at that rate, now there's a spread of financial distress that they're trying to service. So it's the exact same thing with multifamily that I've been talking about over the last few weeks, and I've been actually talking about it since 2018, talking about how interest rates are going to have to stabilize with cap rates, and because interest rates are going up, cap rates have to go up. And for those of you guys who don't know what a cap rate is, it's the percentage of revenue, cash on cash return, that your asset, like this one that I'm standing right now, brings in month over month if you paid cash for that asset. So if you have a 6% cap rate on that, if you have a 6% cap rate on it, but you financed it at 3%, you're cash flowing really well. Well, what happened was people were going in with 3% cap rates and they were getting money at 3% interest, and now they're on an ARM, an adjustable rate mortgage, and those 3-year, 5-year, and 7-year, and even 10-year ARMs are now exhausting, and so people are sitting back on adjustable rate mortgages, and money's become more expensive for them. Hence, that's why multifamily investors that had fluctuating rate mortgages, adjustable rate mortgages, are now in financial distress because they bought their assets at sub 3% cap rates over the last couple of years when cap rates were compressed, and now their mortgages have increased and they're servicing the debt on their properties out of pocket, and their bandwidth to do so is only so far. And so large syndicators and people that have invested in multiple units, people that have 200 units, 800 units, 3,000 units, 5,000 units, 7,000 units, they're starting to get pressed. And it's real when you see companies and REITs just like BlackRock, Greystone, and some of these big guys, when they themselves have gotten halted by our financial institutions, and they're saying, halt, you guys have adjustable rate mortgages, you guys can't afford the debt on it, we're going to force you to sell because we, the banks, are now taking money in at a higher expense, and this is going to push us into financial distress if we don't halt your ability to buy and our ability to lend you money, making investors just like you and myself, giving us the bandwidth to be able to go in and buy these assets at distressed prices, and even as much as 50% off of retail prices from just 2 years ago. That's right. And it's all because of interest rates. And so those of you guys that are looking at the market going, how do I invest? What should I do? This is the time, ladies and gentlemen, to look for financially distressed assets, not physically distressed assets, financially distressed assets, because the banking industry has changed. And if it's taking down large regional banks, it's going to take down large investors, small and medium-sized investors, and this is your time to be able to position yourself with liquidity to go in and pick up the pieces and buy. Look, if you like content just like this and want to be notified when there's more content like this, then click that thumbs up button, click and subscribe to our YouTube channel, and I look forward to seeing you next time.